Hello, everybody. Welcome to another presentation session of the DeFi Risk Learning Group by Nexus Mutual. We will get started in the next 2 minutes. Please bear with us as we wait for more of our viewers to tune in. Hey, Jeremiah. We'll get started in the next minute. We're just waiting for
Hey everyone.
viewers to show up. Welcome. I think we are ready to get things started. Welcome, everybody, to another episode of the DeFi Risk Learning Group, which is a peer-to-peer learning effort organized by Nexus Mutual. We have a special guest today. Jeremiah from Open Cover joins us as a panelist as we talk about experimenting and DeFi. Let's look at the agenda very briefly. Today is all about staying informed and about keeping experimenting in DeFi. Like I said, we're lucky to be joined by Hugh, Brave, Jeremiah, who will be sharing their insights as panelists. In DeFi, keeping up with the latest developments and understanding how things are evolving is very important and not always very easy. Our panelists will walk us through how they stay up to date and maybe even share a few of their secrets. We'll also continue with Brave's very interesting deep dives into different sectors in DeFi. We had a previous episode where Brave talked about lending and borrowing platforms and decentralized exchanges. This is a second episode following that presentation, this time on stablecoins, real world assets. It's going to be a 101 presentation followed by a Q&A. And last but not least, I'll present this month's challenge to all learning group participants who are with us at this cohort. Just to note, I'll tell you more about it when we get there, but it's a cohort-based program, and the next cohort will be open after this summer. If you're interested in exploring DeFi in a peer-to-peer setting, you can sign up through the waitlist, which I will share the link of later. Okay. I want to kick the discussion off with this question. And then have specific questions to each of the panelists. How do you stay informed and stay sane while navigating DeFi? Jeremiah, the guest of honor today. I'd like to start with you. Tell us about your secrets, please.
Cool. Yeah, I mean, that's a great question because obviously there's just so much stuff going on. So I think my personal stack is for short form stuff. Obviously, Twitter, usual suspect, Farcaster as well. You have to be careful because those platforms are designed to suck you in, and there's only so many hours in a day. So you want to be close to the fire. You want to understand what's going on, sort of what's the trend of the day. But yeah, so I do a bit, daily, let's say, a bit of Twitter and Farcaster for short form stuff. On the more sort of like there's this newsletter that I got put on, I don't know when, probably a conference called Radar Block, and it has a lot of sort of the latest in the sort of degen arena of things. So it kind of summarizes well, like the latest big Twitter threads and the like new coin launches and all of this stuff. And it's not stuff that I really participate in oftentimes, but it's good to know just like what's going on. So that's one that I decided not to unsubscribe from, which I find myself reading relatively often. It's the one where I learned that I missed the Hyperliquid airdrop by a few days as well, for example. The like a longer form thing that I read is called the DeFi Report. So there it's more like a deep dive on a specific area. So like, for example, WorldCoin, I think, was the like the latest one. So they'll like analyze, like why is Solana overvalued compared to like Ether or something, and there'll be like a really long sort of like detailed like article about that one topic. Or like WorldCoin, why these folks think that that WorldCoin is going to work or not work. And yeah, I think it's just been acquired by Bankless as well. So I guess I'm not the only one reading it. But I thought, yeah, I also did not unsubscribe from that one. I thought it was quite good. More on the sort of security side, I think the top newsletter is, or the one I found, is called Block Threat. It's by this guy called Peter Kaczerginski, who used to be at Coinbase. And it's just like basically all of the latest weird exploits, like all of the sort of investigation results of stuff you've heard about maybe like 6 months ago, but then there's an actual conclusion to the hack or the, whatever it is. And so that I think is a really, really good one. In terms of just like understanding like what people are doing and what's worth doing as well, because obviously there's just so much. What I do actually is I go to June and I go to the open cover dashboard and the Nexus dashboard, and I look at what covers people are buying, because I think that's a really good proxy for sort of what's quality but also trendy at the same time. And then also obviously the best way to learn is to actually do this stuff. So I'll like if I keep on seeing like, wow, there's a lot of people buying, for example, that's how I put some money into Hyperliquid. A lot of people are buying this like Hyperliquid cover. Wow, okay, like there's something interesting that must be happening there, and so I'll go and check it out, put some money in, see how it works. So I think those would be my tips.
Thanks, Jeremiah. The latter point is one of my interest areas as well. What products people are buying cover for, because it shows that they're both experimenting in DeFi, but also doing it with a risk management perspective, which I find really sane and useful. So yeah, great tips. I will be summarizing all of them to share with our cohort participants and for anyone interested on the forum. Moving on, I want to ask you the same question, but with a different flavor. Where do you go to learn about DeFi, Hugh?
Yeah, some of this stuff's going to be the same, but X's Twitter, whatever, is going to be like one of the main ones. I guess over time I've curated a feed of a lot of the security and risk and I guess protocol experts, and some of them are like kind of like the protocol delegates, like governance delegates and stuff. And so, and a lot of the ones that I've tended to follow and are more the ones that like to take a specific I guess they're not pushing a particular agenda necessarily, or now I know what agenda they're pushing, and so I know which comments to ignore or which ones to kind of focus on. But more kind of the independent researchers or stuff like that. So both on the kind of design and economic side, but also on the technical side, because it's kind of a combination of those two. And then I guess from a day-to-day perspective, I guess I find it relatively easy to keep up, mainly because I'm in it all day. And then we obviously get listing requests from customers wanting to, can I get cover on X or this particular protocol, etc. And so that means we have to kind of go and do a deep dive on it and look at it from a security point of view. But I think one of the things that really kind of helps there is, because we've got the key foundational knowledge of the mechanics and the design patterns, a lot of this stuff is basically the same as something we've seen before, but maybe with one or two tweaks, so you can kind of put it in buckets pretty quickly now, rather than it's not very often nowadays that there's a full new novel mechanic that comes out. So not as much, but obviously still happens, and I love that, but not as much anymore. And I guess one of the ones coming out now is AI, ChatGPT. You can throw stuff in there, and it's getting reasonably good. Like, obviously wouldn't use it for anything super technical right now, but just to get an overall flavor of how something works or how it's designed or what it's similar to or whatever, that can definitely help. So I find myself using that more and more these days.
Thanks, you. I guess it's important to, over time, curate your feed and to get to know who you're following on short-form social media, which I think new people to the space might find it hard to do in a short time. Brave, I want to talk about the current big topics in DeFi and also ask you what you are researching, what you are reading intensively about these days.
Probably have the most inaccessible answer. I'm usually looking at the blockchain directly, or I'm reading reports that are coming out from Immunify on the quarterly losses reports. I'm reading reports from Chainalysis and Elliptic on like the main vectors for loss. So they have really good reporting that you can read, and it's kind of like maybe institutional or professional focused, where it's talking about the industry as an aggregate. What's causing losses, if it's phishing or private key, leaks of private keys, whether that's due to social engineering or because somebody compromised a proxy contract. Again, like very technical stuff, but they have very good reporting on a lot of those larger trends. And then I'm usually looking at, what are the most recent hacks, what's caused those, and digging into those both on chain and looking at analysis. You'll see, like, even after the recent Cork exploit and the CDIS protocol exploit, reading about that on X, on Medium, basically wherever people are, posting their own postmortems or analysis of that, as well as looking at it directly on chain. I spend a lot of my time reading documentation about new protocols or keeping up on governance forums, because a lot of change is happening, especially for lending protocols, for some of these stablecoin protocols that we'll talk about today. You really need to keep up on what's changing at the governance level, when they're changing what assets are being onboarded, what the loan to value is for different assets, some of those things. A lot of those influence the risk that is introduced or taken away from these different protocols. So that's a lot of what I'm reading. I also read around quite a bit, so I'll read reports from the US Federal Reserve. Like I said, reports from Chainalysis and Immunify and Elliptic. I don't think there's any one place that I'm looking for information, but there's a lot of like newsletters and podcasts out there. Jeremiah and Hugh both mentioned some. One that I can recommend that's pretty accessible is the Edge podcast. That's run by DeFi Dad, and he's been around forever. He was, in fact, the one that first talked about Nexus, and that's kind of how I got acquainted with Nexus back in 2020. So I highly recommend that, because he usually does like an overview and then a kind of a deep dive.
We lost Brave for a second, but he was lastly mentioning the Edge podcast by DeFi Dad. Jump back in if you can hear me again, Brave. Otherwise, I will continue with my next question for Jeremiah. Jeremiah, I wonder, we kind of touched upon the first bit, but I wonder what type of content do you think is still missing? What do you think would be useful for the whole community in DeFi?
Yeah, I think there's probably like content overload at this point, possibly. So I think what, you know, I'm not sure it's missing, but I think what I'd encourage people to do is just like try the things, because that's when you really learn and you really understand, like, oh, right, you know, this is how it works. This is the user interface, how it compares to other similar protocols or different protocols. This is why somebody would want to use it. Here are the potential risks if you're thinking, you know, from a risk perspective. So yeah, so I think I'd just encourage people to, I don't know, go to like, you know, DeFi Llama, or, you know, I'm sure some people watching like know all of this stuff, obviously, but if you're like more new to the space, you know, go to DeFi Llama, like check the top 10 or 20 protocols by TVL, which all, you know, represent their category or some version of their category, and then, you know, just try it and think about like, when would you use it? Like, for example, once we needed a really short-term wrapped Bitcoin loan, and we, you know, we went to Aave, and it was like so much cheaper than, well, I mean, I guess it was short-term, so it doesn't matter, but yeah, you know, like you know, you want to kind of know what these big DeFi protocols do and what they're good at, so that when they become useful to you potentially, or when you see a new protocol, you can compare.
Experimenting, right? I hope we will focus on this with our cohort participants this month, but more on that later. Thanks everybody for your beautiful insights. We will get your thoughts after Brave's presentation on stablecoins and real-world assets today. I forgot to delete yield aggregator platforms from there, but we're gonna touch upon yield aggregators at a next session, because we have extensive questions that we hope to touch upon with all of our panelists today. So without further ado, Brave, if you're back with us, we are good to go with Stablecoins 101.
Thanks, Sam. Hey, everybody. Last time we spoke, like Sam said, I went over decentralized exchanges and lending protocols. So my goal this time is to not talk in so much depth about things and just kind of keep things to a general overview so I don't bore everyone to death on this call. If you have questions in the interim, we have some stuff in the Q&A, but if you have questions, just drop them in the chat and we can get to them in the Q&A sections for each of these sections. I know that we have folks from all different kinds of backgrounds on this call, so I want to make sure that everything is accessible. But let's talk a little bit about stablecoins. So I think the first thing is, what is a stablecoin? I'm going to use the definition that Christopher Waller provided in his recent speech. He's a US Federal Reserve Board member. So he defines stablecoins as a type of digital asset that's designed to maintain a stable value relative to a national currency and backed by at least one-to-one with safe and liquid assets, specifically a pool of assets that's held in reserves so that stablecoins can be redeemed for traditional currency in a timely fashion. So redeemability is kind of what people in the Federal Reserve see as a stablecoin, but a lot of times it's just something that has an asset backing, whether that's fiat held in bank accounts, one of the centralized fiat-backed models, an RWA-backed model, which is usually cash-type equivalents, or it could be things like equities, bonds, things of that nature, and it can be a decentralized crypto-backed stablecoin. We see that with things like Liquidity or Reflexer, Synthetics. So there's some models like that where it's just purely crypto, and there's no like off-chain backing component. And then you have some of these hybrid models that combine elements of the decentralized and the centralized models. You can look at Sky Protocol, MakerDAO, kind of the same thing. They have some treasury bills that back a portion of their assets. They have some other real-world assets. Basically, they're providing loans to people in the real world, and the collateral and everything for that is off-chain. So they have crypto also that backs USDS, their stablecoin. But the thing that all of these have in common is that they are over-collateralized, or at least one-to-one collateralized. So if we're looking at centralized fiat-backed stablecoins, the biggest ones here are Tether and Circle. These are held, the asset backing is held in bank accounts, and it's typically in fiat and treasury bonds and short-term secured positions and everything. So a lot of that is centralized. It's off-chain. It doesn't have the same level of transparency that you're going to see on the blockchain. Because Circle is heading toward an IPO, there's going to be more transparency around their backing. They've been pretty transparent in the past. Tether, on the other hand, hasn't been as transparent, but has done more reporting to kind of stay competitive with Circle. Tether isn't based in the US, whereas Circle is. So really, when you're looking at a centralized stablecoin issuer, you want to make sure that they actually have the assets backing the stablecoins that they're minting to ensure that everything is there. So if there's a rush or whatever, you can always redeem that USDC or USDT or whatever fiat-backed stablecoin it is for that underlying asset backing. And in a lot of these cases with these larger companies, you have to be somebody who has a reasonable amount of money to directly redeem it. So a lot of retail users just have to rely on using centralized exchanges or decentralized exchanges to swap out of their positions, or centralized exchanges to actually off-ramp the money to convert it from that tokenized dollar, that stable coin, into fiat that they can transfer back to their bank accounts. There's a lot more of these RWA-backed stablecoins that are popping up. You'll see some firms like Securitize, Superstate, Ondo. There's a lot of other people entering the space, and they're basically offering most of the RWA-backed stablecoins that you'll see are backed by US treasuries or some kind of commodity. There have been some experiments where people have minted stablecoins that are backed by real estate. Those have been relatively disastrous. There's one in particular whose name I can't quite remember, but they had a stablecoin that was backed by real estate. They didn't have a lot of transparency. The stablecoin depegged because people found out they had been taking out loans against that real estate, misappropriating funds, and it never regained peg. So that transparency aspect is really important, and that's typically what you'll see with the blockchain. The decentralized backed stablecoins are a bit different. So this is all on-chain. There's complete transparency in what the asset backing is, but you're relying on the protocol and the smart contracts to act correctly to make sure that liquidations happen in a timely fashion and that the stablecoin itself remains over-collateralized. So in all the cases here, all of these stablecoins are fully collateralized, but maybe due to low market liquidity, you'll see depegs. Synthetics SUSD is currently depegged at the moment and has been since about December. So it's been depegged for 6 months. People's confidence in that stablecoin has gone down. Whereas all of the other ones that are cited here are currently on peg. So it's really important that a stablecoin issuer has some way to maintain that peg over time. A lot of them do it, with hybrid models by having some kind of peg stability module where you can actually redeem that one-to-one, and that helps make up in these times of stress. Moving on to the next slide, we can talk about some of the risks for stablecoin platforms. So the main benefit we know is tokenizing dollars to increase access to fiat around the world. There's a lot of people using stable coins to pay each other, to hold their assets, because maybe their native currency is prone to inflation. So they store their assets in stable coins that are USD denominated or Euro denominated stable coins as kind of a safe haven and a protection against inflation. We see this a lot in South America and Europe. But one of the risks, like I said, are depeg events. So you can have a model that is not secure, like the Terra Luna event that happened in 2022. This was an algorithmic stablecoin. It scaled significantly. They were offering like 20% APY, but under market stress, it did not work as intended. And there was a big flaw in their system. And this led to a rapid depeg event that happened in about 3 days' time. So I think at the time it had like $20 billion in value in UST. It depegged and it wiped out a significant amount of value in under a week. So that was probably the most catastrophic depeg event that we've seen, and they never recovered from that. And a lot of people lost a lot of money. There have been other depeg events. Some of these that I'm talking about here, like Terra Luna and the Fei protocol depeg, these happened to some design failures. Circle USDC, they depegged over a weekend in 2023. And the issue here was just people lacking confidence because there wasn't transparency around Circle's backing. So they weren't sure if they were impacted by the Silvergate bank crisis because they had some funds there. There wasn't transparency on how much was there, so there was a depeg. And then when Monday rolled around, people could redeem again, and it went back to peg. So that was just kind of like a scare. Some of these other ones, they had depeg events, typically due to poor liquidity in the market, due to stressful situations. But in the case of all of these, they've regained the peg except for synthetic SUSD. So like Hugh says, understanding the risk of stablecoins is working out what assets are backing the coin, if it's over collateralized, and if there is an instance where you see a depeg, why is that happening? Is it because there's not enough assets backing that stablecoin? Is it because of poor market liquidity? Usually you'll see people talking about this when there's a big depeg event. So that other one, like we're talking about, is a loss of assets that are actually backing that. That could be due to a regulatory freeze, insolvency of custodial accounts. In the case, when we're talking about the Circle USD depeg, that was because people were worried that they kept a significant amount of funds in the Silvergate bank that went under, but that wasn't the case. Could be due to fraud in the case of the RWA-backed stablecoin that I was talking about, or just insufficient secondary market liquidity. Liquidation failures are also something to worry about because this impacts the asset backing. The big one that we often talk about is the MakerDAO Black Thursday event. So MakerDAO or Sky Protocol is primarily backed by crypto assets, or at least it was in 2020. Now it's kind of a mix of RWA assets and crypto assets. And the price of ETH dropped about 30 to 40% in just a few hours. And because of this, there was extreme stress on the Ethereum network. Gas fees were very high, and there weren't a lot of people bidding to basically liquidate positions. There was a design failure that led to about an $8 million loss. They've since recovered from that, but when it happened, it was a very big deal. Now, looking at things in 2025, $8 million loss really doesn't seem that significant, but at the time, it was a pretty substantial loss. And then, of course, smart contract hacks. This is primarily going to be impacting issuers that are either using a hybrid model of off-chain asset backing and on-chain backing, or for decentralized crypto protocols. If there's some kind of reentrancy attack, some kind of smart contract hack, some Oracle manipulation that allows them to take out the asset backing bugs, anything where they can actually steal the assets that are backing that stablecoin, that's going to lead to a loss for a stablecoin provider. So these are some of the main risks. And again, they vary whether it's backed by assets on-chain or off-chain. And this is where transparency becomes a really, really important factor in determining whether or not a stablecoin provider is actually, solvent or insolvent. So these are a lot of the notable risks. I kind of talked about some of the main features. So let's talk about some of the questions that folks have. So the first one, what risks do stablecoins introduce when used as collateral in DeFi protocols? This is a great question. So one of the big requirements for onboarding stablecoins into a lending protocol is a reliable Oracle source. We've talked about this on previous calls, but smart contracts don't know the price of things. They are just basically executing a specific function. If A happens, then B happens. So oracles are providing them the data of what something's actually valued at. So the smart contracts can know, I need to liquidate this position if the price of this asset goes below this level. So you need to have a reliable oracle that can't be manipulated. Right now, there's actually a big trend of RWA-backed stablecoins or stablecoins with off-chain backing being used in DeFi lending protocols. And there are different ways of doing this. You can just set an oracle to $1. There's a variety of things. But one of the biggest risks here is if there's low secondary market liquidity, but you can redeem the stablecoin for its underlying backing. And sometimes people use a fixed price or a fixed rate price oracle. The problem is if you're using that kind of an oracle, then if there's a catastrophic failure, you're not going to see liquidations that happen. So the different risk providers working for Aave, the risk curators working in Morpho, they're looking at all of this when they're determining what stablecoins to introduce as collateral in these protocols. And you'll see discussions on these governance forums that I was talking about earlier on whether or not something's suitable and what the supply cap's going to be for that asset when it's onboarded. So the risk is if you introduce any asset that has low liquidity or isn't very reliable, that it could lead to bad debt and losses for lenders on these lending protocols. So those are some of the biggest risks that you're going to see. And again, stablecoins backed by off-chain collateral are going to pose some of the bigger risks, depending on if there's enough liquidity or if redeemability is possible during times of stress. How can users access the actual risk exposure of using stablecoins in yield farming strategies? Oh, assess the actual risk. Again, this goes to verifying the asset backing and the available liquidity. So if you see a yield opportunity where you can earn 100% APY on a stablecoin, but there's not a lot of liquidity and you can't redeem it directly yourself, then it's probably not a good, yield opportunity. Because if you can't actually exit the position, then it doesn't matter if you earn 1,000% APY. I always tell people 100% APY on zero is still zero. So that's the biggest risk of some of these things. So looking at secondary liquidity and whether you can redeem that stablecoin directly, those I think are the two biggest things to assess when you're looking at using stablecoins and yield farming strategies, as well as the underlying risk involved in a DeFi protocol. One proxy a lot of people use is looking on Nexus at our pricing to see what the price of a certain protocol is. But yeah, I'll let Hugh speak a little on this if you'd like.
Oh yeah, thanks, Brad. I was just trying to add some flavor with a few extra comments. But yeah, like the stablecoin space is like expanded massively with lots of different options, and so it's often really hard to work out is A more risky than B or etc. And I think there's a lot of stuff going on, but the key is really the understanding the assets backing, because if you can get a good handle on that, you can get a good handle on most of the stablecoin and if it's redeemable, etc. And so a lot of assets backing can be cash or can be treasuries, but sometimes it's like there can be real estate or something. But like if there's not so then as soon as you kind of get that involved, you kind of got legal risk and you've got other asset price risk that who knows what those actual assets are and how often are they valued. Like often if you've got real estate backing, it can be valued once every 3 years by an independent valuer. It doesn't actually get sold, so you don't have a real-time price feed and stuff. There's all of these types of issues that get bundled up all together. If you talk about Athena, for example, they're running I won't get into the details, but just very quickly, they're running like a long short strategy where across multiple centralized exchanges and different places, and you've got execution risk, you've got the exchange risk of potentially things. So there's lots of, and I'm not saying it's necessarily bad, but there's lots of detail in there that it's very hard to get into and really understand, and it's not very transparent. And so it's often very difficult unless you're a real expert to really get a gauge on these risks, etc. So often, yeah, I guess one of the places obviously is you can look at Nexus, and a bunch of these risk experts have actually priced this stuff and kind of give you like with DPEG coverage, and so you can get some handle on the risk. That's just what obviously the risk experts on Nexus is just one view, and there's other views out there, but it is often quite a complex thing. But I guess I encourage people to, if you want to really understand the risks of the stable coins, a lot of it's going to come down to what are the assets backing and what are the underlying risks of those assets backing disappearing or being valued much less.
Thanks, Hugh. Thanks, Brave. We have a few more questions on stablecoins. Sorry. So one of the questions, we had a couple questions. I bundled them into the decentralization theme. One cohort participant is asking about how different types of stablecoins compare in terms of decentralization and risk, whether fiat-backed versus algorithmic fare differently on the risk scale there. And also we have two participants asking about whether stablecoins are important as a bridge between TradFi or DeFi, or maybe something that hinders full decentralization. I want to ask Jeremiah if you'd like to share anything on these questions. They're a little harder to say at one go, but please feel free to refer to any, or I'll jump to you.
Sure. Sure. Yeah. So obviously, like echoing everything that Brave and Hugh said, I think there was one, just to wrap up on that topic, I think there was one interesting initiative by S&P Global, which is like a kind of TradFi rating agency, they tried to do like ratings of these different stable coins. And I was just looking on Google at these reports. So maybe I can share the link afterwards. But basically, there's been some attempts to do a sort of standardized framework to rank these stable coins based on what's backing them, governance risk, liquidity risk, all of that. So I think it's worth, or like I remember reading one of these reports and I thought it was quite interesting to see like the level of detail they went into and the criteria that they were using. But like coming back to, I guess, stable coins. So I think what's interesting with stablecoin, like one of the reasons why blockchains exist is to make value programmable. So we've got, whole point of the internet is to connect people and to enable everybody to be like a sort of creator of information, consumer of information, decentralized, who, you get to choose what your information sources are. You get to contribute to your own sort of insights, whether it's on social media, making your own website, writing articles, whatever it is. And so what was missing kind of there is being able to program values, is being able to use the same kind of rails to transfer value, not just information. So in a way, stablecoins are super important because you want to be able to use the same frame of reference and the same kind of like currency you use off-chain, on-chain, and send the same type of value. So it's very convenient to be able to send dollars directly on, an L2 or Ethereum or whatever, a blockchain, and much faster and cheaper than if you use like a Swift transfer. So I think, I guess my answer to the second question, I think it is, I'm not sure that decentralized, I don't want to say like decentralization is not the goal. I think it's more that like decentralization is one of the ways we achieve more like, I guess, equality and access to information and wealth. And so in a sense, stablecoins are important for that. And as we said, there's many different ways to implement them. And the good news is you get to choose which flavor you wanna use. Does that make sense?
Yeah, I think it does. I might jump in there because I think you said something really good. Like, people get to choose what they want, but kind of like the different flavors of stable coins. There's a reason like the full decentralized ones haven't taken off as much as the fiat-backed ones, and so in general, there's three kind of categories in my mind. There's fiat-backed, there's crypto-backed, and then there's algorithmic, which is kind of a subset of crypto-backed perhaps, but I think it's important to distinguish that. So the first two, fiat-backed and crypto-backed, they're all like fully backed, but the fiat-backed ones are going to be more scalable. They'll be able to hit escape velocity a lot quicker, and an important thing about a stablecoin is how readily does someone else accept it, and do they want that asset, right? So that they, who wants the same flavor of US dollars as me? And so you're more kind of, there's a kind of you always kind of go to the bigger ones that already have some scale because they've got a moat and that's helpful, right? And so the fiat-backed ones are generally more scalable than the crypto-backed ones, primarily because the amount of assets in crypto is less than the trillions of treasuries, etc., that are sitting out there or whatever it is, and other real-world assets. And also the crypto-backed ones tend to be over-collateralized, so you have to like lock up $1.50 to mint $1 of stablecoin, so it's less scalable, and you have to find enough people wanting to do that and take on the debt. So that's kind of thing. On the algorithmic side, I mean, there's different flavors of algorithmic, but the kind of purest form of algorithmic is where you back it with what's called an endogenous token, which is kind of your made-up token, and it's kind of like when the US dollar went off the gold standard. The US dollar used to be backed by gold, and now it's not backed by anything really apart from the US government and stuff like that. And that's fine, and that works, and everyone thinks that's okay. But it's like you're kind of coming up with this thing over the other side, over here, that hasn't built up years or decades or centuries of trust, and you're just saying, here, trust this, that'll have some value. And like, I think that algorithmic bucket is really, really very scalable, but it's very, very, very risky. And like at the moment, I don't trust anything that is in that bucket. I've never really have. In theory, I think you could get to that point, but I think you kind of have to go through either fiat-backed or crypto collateral over collateralized to get to that point. So you have to build up trust over decades, perhaps longer, before you can go into that category. But so yeah, basically from a risk perspective, I honestly wouldn't touch anything algorithmic. Terra Luna being the kind of key prime example, but there's others as well. But the other two are kind of okay from a risk point of view, but they kind of depends on the particular setup and how it's structured and all the rest of it. And so those are the kind of two main ones that we've been focusing on so far in this call.
The only thing I'm going to say here is there's a reason why I didn't cover algorithmic, because I would just recommend not touching it, because nothing has worked so far, and there are enough good models that people can experiment with. Don't mess with algorithmic stuff. It hasn't worked out well to date, so I would not recommend it. All right, let's talk about real-world assets. So by now, I'm sure most of you have heard of the term real-world asset used in reference to Ethereum or another blockchain. So some of you have asked questions about RWAs, and I wanted to give a brief overview of the RWA space, talk about the promise of RWAs, some of their pitfalls, and the role they'll play in on-chain markets in the future. So like we did with stablecoins, let's start simple and define what a real-world asset is. So real-world assets are tangible assets that exist outside the digital realm. These can range from bonds to real estate properties, commodities, can be tokenized cash flow, can be quite a few different things. So when we're talking about RWAs in a blockchain, we're talking about digital tokens that represent these physical, traditional financial assets. So this can include currencies, commodities, equities, bonds, like I said, quite a few different cases. The tokenization of RWAs is seen as one of the largest market opportunities in the blockchain industry, with a potential market size in the hundreds of trillions of dollars. This is something that we'll talk a little bit more about BlackRock, but they've talked about the benefits here as well. So when an issuer decides to tokenize a real-world asset and offer it to investors in on-chain markets, they go through a process where they determine what legal structure and financial vehicle they're going to use to hold the underlying assets. This might be a trust or a special purpose vehicle. They create a process for minting tokens that represent a legal claim or ownership on the underlying assets. A lot of times they'll have requirements where you have to KYC to actually use that asset. You have to go through the KYC AML process, or you have to be an accredited investor or a qualified purchaser. So there's a lot of requirements there. In a lot of cases, people are actually tokenizing securities and different kind of equities that have these different regulatory requirements for you to actually hold and trade these on chain. So these issuers provide potential investors with information on how to invest in that tokenized RWA, what their legal rights are and what the requirements are. Like I said, some of these can only be purchased by accredited investors. This is especially true for tokenized securities like BlackRock's Billable Fund. So from there, token holders can accrue value directly to their token or receive dividends depending on the type of underlying assets that back the RWA. And since assets backing RWAs are held off-chain, investors are depending on the established legal rights and transparency offered by the issuer. Of course, these are the strongest where the RWA is actually managed by a regulated issuer that is regulated by the SEC or some other board in other countries. Well, let's talk about some of the benefits. With RWAs, you can do a lot of different things. You can trade 24/7. You're not limited to when the market's open. You have faster settlement, increased transparency, and reduced costs. I think one of the best examples is Larry Fink, the CEO of BlackRock, wrote in his annual chairman's letter to investors that you can tokenize everything, right? If you can tokenize every bond, every fund, every asset and put it on chain, that means that you're not limited to when the market's open, that you can improve efficiency in a lot of different markets. Instead of having to settle in days, you could clear something in seconds, and you could add a lot of value to the current markets just by having faster settlement, increased liquidity, and making it easier to trade. So it is a massive area of opportunity, and people like BlackRock see this. So there's a lot more attention in the RWA space because of these benefits. I used to work in the municipal bond industry, and even in this day and age, trading municipal bonds is still kind of clunky. It's better than the days of holding a physical coupon, but if you could tokenize bonds and there could be a more efficient secondary market, I mean, that would unlock tremendous value for the bond market. And I think this is true of most markets. Let's talk about some examples of RWAs. So I'll talk about BlackRock's Buildo Fund first. This is the first regulated tokenized market money fund that was issued by BlackRock on the Ethereum network in March of 2024. As a lot of people know, BlackRock is a massive financial company. And so them entering into the crypto space and looking at tokenized securities is a very, very big deal. They partnered with Securitize, which is a digital securities platform that's been in operation since 2017 and regulated by the SEC since 2019. Like I said, they've said many times the key benefit of tokenizing assets are expanding investor access to on-chain offerings, providing instantaneous and transparent settlement, and allowing for transfers across platforms. So what the Buildo token is doing, it's backed by US Treasury bills, overnight repurchase agreements, and cash, and it's offering holders a stable value of $1 per token, and it pays daily accrued dividends directly to investors' wallets as new tokens each month. The AUM on this is pretty large. It's approaching $3 billion. And so what this fund does is it invests 100% of its assets in cash, US Treasury bills, repurchase agreements, and it allows investors to earn yield while holding that token on the blockchain. So these investors can transfer their tokens at any point, right? 24/7, 365 days a year to other pre-approved investors. So fund participants have the flexibility on how they want to custody their assets and how they want to hold their tokens over time. But to invest in Buildo, you have to have a minimum investment of $5 million, and you need to be a qualified purchaser, which is a higher bar than the accredited investor status. So this one isn't accessible by most people. You have to be kind of like a high net worth individual to be able to access this Buildo fund. There are other examples too. We can share a link to the Securitize website where you can see the different kind of RWAs that they currently offer. And there's other issuers too, but that's a pretty large example. One of the other ones I want to talk about is the Reinsurance Member Fund. So Cover Re worked with Securitize to launch the Member Fund in May 2024 on the Avalanche blockchain. And what Cover Re does is they tokenize access to reinsurance markets and the returns paid for providing liquidity to select reinsurance markets. To be more specific, the underlying assets backing Re's fund are senior tranche quota share notes that back a diversified book of U.S. property and casualty insurance programs like auto, home, workers' comp, trucking, cyber risk. Like I said, a variety of different property and casualty insurance programs. The target returns for that fund are in the 20 to 25% range. And this one is very interesting because right now there is huge demand for excess capital in the reinsurance market. There's not as much capital that's available to underwrite some of the risks in the reinsurance market. So taking on-chain funds, USDC to be specific, and putting it into this fund helps provide access to markets where there is a big need for additional liquidity. Nexus Mutual is actually an investor in Re's fund. We allocated an initial $10 million investment in Re's fund last year when it launched. We're currently waiting for an on-call update from Re, but he was talked about the initial report that we've received to talk about what the mutual has earned. Hugh, do you know by chance what the projected return was based on the last update we received from Re?
Yeah, it was in the 20% range. I'm getting another update shortly, but definitely on target from what we kind of agreed up front. So it's going well so far.
Yeah, and I think these two cases are really interesting. You know, the AUM for the reinsurance member fund isn't quite as large as BlackRock's fund, but it's $140 million. So it is a pretty sizable fund. These two use cases are very interesting because it's not as easy to trade these things back and forth. Tokenizing these and increasing access to trading between, you know, accredited investors in the case of RE's reinsurance member fund, or qualified purchasers in the case of the billable fund, is really, really important. So these are two examples. There's a lot of other ones that we could talk about, but instead we'll share some resources so you can check some different ones out. But I know we're running short on time, so let's talk a little bit about some of the risks. And we can talk about questions too, but I'll just run over some of the risks because we have that in the questions. So what are the risks of trading tokenized real world assets through smart contracts? It kind of interestingly enough, smart contract risk isn't the greatest risk with RWAs. The risk might come if you're using an RWA in a lending protocol or something, but if you're looking at the RWA protocol itself, a lot of them require KYC. So in the case of something like Billable or RE's fund, they actually don't allow you to transfer the tokens to somebody that's not either a qualified purchaser or an accredited investor. So if somebody is trying to scam you and steal your tokens, if they're not KYC through that fund, that transaction is going to fail. If somebody were to steal funds, or if there was some kind of exploit where they could mint more tokens, they wouldn't actually be able to redeem them. And what would likely happen is they just reissue the tokens on chain. The asset backing isn't held on chain. So again, the smart contract risk is actually low in this case. The largest risk that you're going to see are legal risk, counterparty risk, custody risk, you know, some of those assets, what you would see in the traditional financial world. And again, that's where you want to work with a regulated RWA issuer. There are other ones that don't provide as much transparency. Maybe they don't provide the same legal disclosures. You want to make sure that as a token holder, you have legal rights, which is something that we can talk a bit more when we talk about some of the other questions. I don't know if there's anything else that anybody wants to add in on that first question, or if I've covered it. Okay, cool. How can RWA-based products be insured on-chain? This is a good question. So this could be a custodial aspect. You could basically underwrite the risk of a default for some RWA-based product. Again, when we've talked about insurance before, insurance on-chain, it doesn't have to be fundamentally like smart contract risk. It can be a lot of traditional risks that insurance providers cover. So really, it depends on what the RWA vehicle is, who the issuer is, but you can still have kind of the same insurance products that you'll see in traditional finance offered for these RWA assets, you know, depending on what the underlying risk is.
I thought I'd just quickly to jump in on that one, because I think one of the interesting mechanics that DeFi has that kind of can wrap everything up here, and I think it's really elegant, is DPEG coverage. So it obviously doesn't necessarily work for all RWAs because you need a certain amount of liquidity to have markets, etc. But an interesting mechanic that we have in DeFi is allowing paying a claim on a specific DPEG. Like if that DPEG's greater than, I don't know, 5% over a few days or something like that, then you pay a claim, and that can effectively wrap up or bundle all of the risks together. So it kind of bundles up all of the off-chain risks. It bundles up all the on-chain risks as well, and you can kind of put it all in a nice, neat little package. And that's one really interesting thing that we can do in DeFi that's really, really hard to do in TradFi. So it doesn't necessarily work for all RWAs, but it is a pretty cool product, and I really like the elegance of it. So, you know, Nexus offers it. There are other protocols that do it as well, like Cork. But I think it's a really cool primitive that's quite neat. And especially where the RWAs have liquidity, I think it's a very good solution.
We had quite a few questions about risk and resilience, which Hugh and Brave already responded to as part of our DeFi AMA series, which you can find on YouTube. That's why I want to jump over to this last theme, tokenization, what and why, what types of real world assets are most likely to be tokenized first and why. We already have some examples. I wonder what you guys think about the next wave, what you think will happen up next. And also, we will have a guest speaker who is more knowledgeable about the legal side of things next time in 2 weeks. But if there are any legal or regulatory hurdles that are very prominent. Brave, why don't you start us off?
Oh, I'm going to let Hugh and Jeremiah take a stab at this first before I answer, so I don't have to talk the whole time.
I'll go quickly first, and Jeremiah, you can jump in. So I think the obvious stuff that has demand first, like it's probably the things that work at the moment in the TradFi world, and we can just put that on the chain and tokenize it and do something very similar to what we're doing, but we access deeper liquidity pools and make it more useful. I think that's the type of stuff that's going to get tokenized first. I think the more interesting stuff is going to be the tokenizing the things we haven't done before. But I think that comes as a second wave. So yeah, I think that's going to be interesting, and I think there's some like really weird and wonderful things that you can do that are non-traditional asset classes. But it's probably there's a whole nother topic on that one. I think the legal and regulatory hurdles, they'll definitely be there, but as soon as you have the BlackRocks of the world getting involved, they've got enough firepower to work out how to do this. And so I think these types of barriers are starting to get broken down as people put the effort in and work out how to do it. I don't think there's any necessarily blockages there that means it's never going to happen. It's just you have to work through them step by step. So that's my quick take, just at a kind of high level.
Any further notes from anyone before I move over to this month's challenges?
I think Hugh covered it pretty well. I think as far as legal hurdles, it's really going to be up to kind of where regulation goes. One thing I was going to mention here on this kind of fits into the risk side is you need to make sure that you have legal rights as a token holder for RWAs. Sam can share this resource later, but their Paper Imperium is somebody that's very active in DeFi, and they're very active looking on different governance forums. They talk a lot about RWAs and credit risk. And one thing they say is if we're building, RWA platforms on chain, then we have to make sure that people understand their legal rights and what the quality of the assets are. Looking at some of the earliest RWAs that were issued in 2021, they're like the worst kind of junk bond status, and they have not performed very well. They've had high rates of default. So what we want to see is more regulation and more legal disclosures from RWA providers, which is why I'm very hopeful on the regulatory side. I think at least in the US, there's a lot of support for getting regulations in place for this stuff. So I guess we'll have to kind of see with that. But I look forward to you having somebody who's an actual lawyer that's qualified to speak to these things in a couple weeks, Sam.
Thank you, Brave. Thank you, Hugh, and thank you, Jeremiah. We are a bit over time, but I just want to make a few reminders and then wrap up the call. Up next on the 18th, we will have Brave walk us through the most important things to know about yield aggregator platforms. I know that a lot of participants and viewers are especially excited about this episode, which is a very unique side of DeFi, where yield is generated through interacting with multiple protocols and platforms. I also want to remind the DRLG participants of the June challenges. I will detail them in an email later today or tomorrow, but this month is all about bringing a reading to the table. It has been a little over 2 months that we started this first cohort, and I know that most of our participants are already quite knowledgeable in the space. I wonder how a reading potluck would look like. I will share the resources that our panelists share today, and we'll go from there on the forum. We have David's question on the forum, and also Moss had a feedback about the curriculum. I'll respond to them on the forum, just let you guys know. And yeah, that's it for today. Thank you for joining us. Thank you, Jeremiah, Hugh, and Brave, for your insights. We look forward to seeing you with us again in 2 weeks' time. Stay safe in DeFi and take care. Bye.
Thanks, everyone. Take care.
Thank you. Bye.